Welcome to today's video, where we tackle one of the most common investor fears, buying at an all-time high. We'll explain why that fear is often a psychological trap, how to invest strategically when markets feel expensive, and how dollar-cost averaging and a disciplined asset allocation can help you build wealth over the long term. Here is our agenda. First, we will reframe all-time highs with data and context. Next, we will show you how to deploy a lump sum using dollar-cost averaging. Then, we will separate core holdings from satellite positions and discuss a sensible allocation. After that, we will cover time horizon and liquidity rules to avoid unnecessary risk. We will also include 2 quick quizzes to reinforce the key points. Finally, we will end with an action checklist you can use right away. Before we begin, this video is for educational purposes only and does not constitute financial advice. Markets involve risk, and you should make decisions based on your own research, risk tolerance, and financial situation. Consider consulting a licensed professional before acting on any ideas presented here. To begin, let's reframe what an all-time high really means. Historically, new highs are not rare events. They occur frequently in long-term, upward-trending markets. Waiting for a dramatic correction often results in missed opportunities and lost compounding. The fear of buying the top is largely psychological and not a strategy. The key idea is that time in the market tends to beat attempts at timing the market. Now let's translate this into action with a simple decision tree. If you do not have investable cash, automate contributions on your paycheck cycle. If you do have investable cash, ask whether it is a large lump sum. If it is not, invest immediately in your target allocations. If it is a large lump sum, then dollar-cost average over 3 to 6 months with a predefined schedule and percentage per tranche. Allocate primarily to core index funds spanning the United States, international developed markets, and emerging markets. Keep real estate as a modest satellite holding, and, if you choose, include a limited individual stock or option sleeve. Then, rebalance quarterly or semi-annually. The overarching rule is to avoid timing the market and instead follow your process. Next, let's make dollar-cost averaging concrete. First, define your target allocation before you place any orders. Second, choose a 3 to 6 month schedule, such as biweekly or monthly. Third, divide your lump sum into equal tranches that align with your schedule. Fourth, automate purchases into low-cost index exchange-traded funds that cover U.S., international developed, and emerging markets. Fifth, establish rebalancing checkpoints, either quarterly or semi-annually. Finally, document your rules so you are less likely to make emotional decisions during market noise. Moving on. The majority of your portfolio should be allocated to core holdings, broad, low-cost index ETFs covering the United States, international developed markets, and emerging markets. This core should generally be 60% or more. Satellite positions may include a modest allocation to real estate investment trust ETFs and, if appropriate for your risk tolerance, a limited sleeve for individual stocks or options. Keep cash for near-term needs separate from your long-term investment portfolio to avoid forced selling. Rebalance according to a schedule rather than reacting to headlines. Furthermore, when comparing lump sum investing with dollar-cost averaging, lump sum deployment has the highest expected return historically because more of the money is exposed to the markets sooner. It captures compounding earlier, but it can be psychologically difficult because drawdowns feel worse. In contrast, dollar-cost averaging over 3 to 6 months reduces regret and timing stress by smoothing the entry price across market noise. While its expected return is slightly lower than investing the lump sum immediately, it often increases the odds of sticking with the plan, which can improve real-world outcomes. To keep costs low, consider broad index funds with low expense ratios. Here are illustrative examples, not endorsements, and expense ratios are approximate and subject to change. For the U.S. total market, well-known products have expense ratios around 3 basis points. International developed market funds can be around 7 basis points. Emerging markets funds often range from 8 to 9 basis points. U.S. REITs funds may range from roughly 7 to 12 basis points. Always verify current fees with the provider. Now, let's address timing. Market timing often feels intelligent in the moment, but it rarely works consistently. Structured rules outperform ad hoc guesses, which is why automated contributions and scheduled rebalancing are so valuable. If you must make discretionary bets, confine them to a small satellite sleeve. In all cases, your written plan should be more important than any short-term prediction. Meanwhile, match your investments to your time horizon. Money you will need within 3 to 5 years should not be exposed to stock market volatility. It belongs in liquid accounts, such as high-yield savings or similar. Aggressive allocations, particularly those including individual stocks or options, demand a minimum 10-year horizon to ride out drawdowns. Always align the asset with the time you can leave it invested. Quiz time. The question is, at an all-time high with a large lump sum, which approach best balances behavior and returns? Option A, wait in cash for a major crash. Option B, dollar cost average the lump sum over 3 to 6 months into broad index ETFs. Option C, go all in on short-dated options. Option D, buy only real estate ETFs. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is to dollar cost average the lump sum over 3 to 6 months into broad index funds. This approach reduces emotional stress from timing while ensuring you still enter the market and benefit from compounding rather than sitting in cash indefinitely. Second quiz. Which funds should generally not be exposed to stock market volatility? Option A, money needed in 1 to 3 years. Option B, money invested for 10 or more years. Option C, a long-term retirement account. Option D, a diversified core index portfolio with a long horizon. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is money needed in 1 to 3 years. Those funds should remain liquid to avoid the risk of being forced to sell during a market downturn. Longer horizon investments can accept volatility in exchange for higher expected returns. Here are the key takeaways. First, all-time highs are normal in long-term upward trending markets. Second, stop timing the market and adopt rule-based allocation. Third, when investing a large lump sum, dollar cost average over 3 to 6 months. Fourth, maintain a core allocation of 60% or more in broad, low-cost index ETFs spanning U.S., international developed, and emerging markets. Fifth, treat real estate ETFs as satellites rather than as the portfolio core. Sixth, match assets to their time horizon. Near-term funds remain liquid, while long-term goals can be invested in equities. To visualize the framework, imagine a mind map with disciplined investing at the center. The first branch is allocation, comprising a core of broad index funds across U.S., international developed, and emerging markets, and a smaller satellite sleeve for real estate and other small, intentional bets. The second branch is automation, which includes a dollar cost averaging schedule, automatic contributions, and periodic rebalancing. The third branch is behavior, emphasizing written rules, ignoring headlines, and maintaining a long investment horizon of at least 10 years. To wrap up, convert these ideas into action. Write down your target allocation and your dollar cost averaging rules today. Automate contributions and rebalancing so the plan runs even when you are busy. Keep near-term cash needs out of the market to avoid forced selling. Finally, stay invested despite headlines, because time in the market tends to win over attempts at timing. Thanks for watching. If this video helped you, please like it, share it with a friend who needs to stop timing the market, and subscribe for more breakdowns. Tell us your plan in the comments, including how you will structure your dollar cost averaging and allocation. See you in the next one.